Stock markets, bond markets, the economy, policy. Some years they push and pull on each other lightly as markets follow their path. In others, one influence can dominate. But sometimes, often following a period of change, understanding the pushes and pulls and how they might interact becomes a key to reassessing market dynamics for the year ahead and beyond. LPL Research's Outlook 2017, Gauging Market Milestones, will help you read the gauges and make adjustments while staying strategic and maintaining a long-term view as you pursue your financial goals. For 2017, we expect the bull market may continue with a potential pickup in the pace of economic growth as rising business investment and fiscal stimulus complement steady consumer spending. We will be monitoring three key areas. First, a smoother path to policy changes. A Republican president working with a Republican Congress should smooth the path for implementing policy changes. Both the timing and the actual details on issues such as fiscal stimulus, tax reform, deregulation, and trade will help set the market direction. Second, a return to earnings growth. With the earnings recession at an end, in 2017, we expect mid to high single-digit earnings growth potentially supported by an accelerating U.S. economy, rebounding energy sector profits, and steady profit margins. Third, the Federal Reserve is in play. Fed policy is driven by the dual mandate of keeping inflation low and the economy near maximum employment. Both sides of the mandate may look different as the labor market approaches full employment and inflationary pressures increase. In 2017, we expect economic momentum, fiscal policy, and a more business-friendly regulatory environment may help real GDP accelerate to a range closer to 2.5%. The odds of recession, based on leading economic data, remain low. However, the risk of a recession due to a policy mistake, monetary, fiscal, trade, or immigration, has increased in 2017. President Trump and Congress will likely enact pro-growth policies in the first half of the year. These policies may boost economic growth, but would likely shift the drivers of growth from an emphasis on the consumer to a mix that includes manufacturing, capital expenditures, and government spending. Although gains in the labor market will likely continue to moderate in 2017, job growth remains robust enough for the Fed to feel confident. Inflation, which has been dormant due to falling commodity prices in recent years, may make a comeback as above potential GDP growth and a tightening labor market push up wages and ultimately inflation. If we meet the Fed's forecast for the economy, labor market, and inflation in 2017, the Fed will potentially raise rates twice during the year, with 3 hikes more likely than 1. Turning to the stock market, we expect mid-single-digit returns for the S&P 500 during the year and the continuation of the nearly 8-year-old bull market, consistent with historical mid to late cycle performance. We expect S&P 500 gains to be driven by 4 factors. 1, a pickup in U.S. economic growth, partly due to fiscal stimulus. 2, earnings gains from corporate America. 3, an expansion in bank lending. And 4, a stable price-to-earnings ratio of 18 to 19 times. Gains will likely come with increased volatility as the economic cycle ages. Our forecast for earnings growth in the mid to high single digits is well above the flat earnings of 2016 and consistent with long-term averages. After more than 2 years of earnings declines in the energy sector, we expect earnings growth to return based on our expected oil price stability. In addition, we believe any further rise in the U.S. dollar in 2017 may be contained, although we do consider currency uncertainty to be one of 2017's bigger risks to earnings. Within international markets, we expect that 2017 may be the year of improving fundamentals, but increasing risk. Both developed and emerging markets saw their corporate earnings pictures improve in 2016, with expectations for further growth in 2017. However, we remain cautious on international investments due to global geopolitical risks. As mentioned, one of the greatest risks is currency uncertainty. We would prefer to see stabilization or even a decline in the dollar before making further investments into international markets. Focusing on fixed income, while our forecast for bonds remains muted, we do expect the 10-year Treasury yield to end 2017 in its current range of 2.25 to 2.75%, with a potential for a 3% yield at some time during the year. Despite prospects for low returns, fixed income allocations should nonetheless be maintained in suitable investors' portfolios as they play a vital role in diversification. Due to expected upward trending economic growth and inflation, in addition to Fed rate hikes, high-quality bond prices may be under pressure in 2017. Turning forecast to action, let's recap how to invest. We expect stocks to outperform bonds in 2017, but with the overall return environment for most asset classes modestly below historical levels. We see similar performance between growth and value. Small caps may outperform early in 2017 due to the possibility of supportive policies and expanding bank credit under a Trump presidency. An aging business cycle may favor large caps later in the year. On a sector basis, we are monitoring healthcare, which may benefit from a more benign regulatory environment. Technology valuations reflect overly pessimistic expectations based on assumed policy impact and may present an attractive opportunity. Industrials may benefit from increased infrastructure spending, and reduced regulatory barriers and potentially higher oil prices support master limited partnerships, though rising interest rates carry risk. Despite improved fundamentals and attractive valuations, especially in emerging markets, we would want to see further evidence of dollar stability before adding to positions. Currency hedging remains a viable option in developed markets, particularly in Europe, to help dampen some of the investment risk in those markets. With fixed income, we continue to favor intermediate-term bonds with an emphasis on investment-grade corporates and mortgage-backed securities, given the backdrop of range-bound interest rates in 2017. Lower quality fixed income may be supported by business-friendly policies in line with our positive view on equities. Therefore, a small allocation to high yield and/or bank loans may make sense for some investors. We've shared a lot of information here, and more guidance can be found in our LPO Research Outlook 2017 publication. We encourage you to leverage Outlook 2017 and consult your financial advisor as you seek to make progress towards your long-term financial goals. Thank you for listening.